So let's start with the absorption costing question 3, because as you said, we finish question 1 and 2. We finished these two questions in the previous lecture, and question 3 was your homework. So let's start. So this is your topic 5. And we are discussing about its cost allocation methods. Cost allocation method. And in this cost allocation method, we finished absorption costing. Absorption costing. So let's have a look at the homework. So question 3. So here is your question. And in these questions, we quickly have a look. This company manufacture and sell a single product, right? And we have selling price per unit, we have direct material, direct labor, and variable overhead, right? Fixed production overhead costs are budgeted at 400,000 per annum. Per annum means per year, right? And normal production level are thought to be 320,000 units per year. So what does it mean? It means 400,000 pounds divided by 320,000 will be your fixed cost per unit, right? Fixed overhead cost per unit. This is your fixed production overhead, fixed cost per unit, all right? Because in order to calculate manufacturing cost per unit, manufacturing cost per unit, we need direct material per unit, direct labor per units, overhead per unit. All right, we have direct material, which is 10, direct labor, which is 4, variable, which is 2.5, and this number, all right, I don't know how much it will be. You can check later. So this is variable cost, and some number will be fixed cost. So some number will be here. So that's your manufacturing cost per unit. Now, next is budgeted selling and distribution cost are variable. This is selling and distribution cost. Selling and distribution cost means this is your non-manufacturing cost. Non-manufacturing cost. So your non-manufacturing cost, which is variable, right? Variable non-manufacturing is £1.50 per unit sold. So remember, sold. Obviously, marketing or advertising cost depends upon your sales unit. It's not depends upon your production unit. Then you have a fixed 80,000 per year. So this is your fixed non-manufacturing cost, which is 80,000 per year. Now we have some further information. We have a sales for January to March. So January to March, quarter 1, and April to June is a quarter 2. So we have a 2 quarters information, 6 months information. But of course, you have to calculate everything's 3 months, right? So January to March, we have a sales unit, which is 60,000, and production unit 70,000. For April to June, which is quarter 2, for this quarter 2, sales unit is 90,000 and production unit is 100,000. So we have to calculate net profit using absorption and marginal. So we will check absorption costing, right? So let's have a look at the absorption costing. So that's your informations. This is your January to March, January to March, and April to June. Right. Okay. All right. So let's start. So this is your question 3, right? Absorption costing. So let's start with the sales. So make sure you keep telling me side by side that whatever I'm asking you about sales or cost of goods sold, every information. If you want to speak, you can speak. If you want to send any number in a chat box, so you can send in a chat box, right? So let's start with the sales. So how much is sales for January to March? $2,700. 2,700, or yes, this is 2,700,000, not 2,700. So make sure you'll check again. 2,700,000, right? January to March. And now what we need next is a cost of goods sold. And how do we calculate cost of goods sold? So here is a cost of goods sold. So in order to calculate cost of goods sold, we calculate manufacturing cost per unit. Manufacturing cost per unit. How much manufacturing cost per unit did you calculate for quarter 1? Manufacturing cost per unit total. Total means direct material per unit plus direct labor per unit plus total overhead per unit. So how much is total? 17.75. That's right. 17.75 pounds per unit. All right. And now multiply by cost of goods sold unit. And how to calculate cost of goods sold unit? So we have our formula for cost of goods sold unit. Formula is a opening inventory, right, plus production less closing. That will be your cost of goods sold unit. So how much is opening? Opening, how much? 0. Yes, 0. Plus production. How many we produced? 70,000. Yes, 70,000. And how much is closing? 10,000. Yes, 10,000 is closing. So this number is a 60, right? 60 multiplied by 17.75. So how much is cost of goods sold? 1,065,000. That's right. All right. So this is your cost of goods sold. So how much is your gross profit now? So gross profit. Gross profit is 1,635,000. Right? That's your gross profit. Minus non-manufacturing cost. Non-manufacturing cost. Non-manufacturing cost. So this non-manufacturing cost, we have two types of non-manufacturing cost, which is variable non-manufacturing cost and a fixed non-manufacturing cost. All right. So how much is variable non-manufacturing cost? How much is variable non-manufacturing cost? No, total. So 1.5 is a per unit. 1.5 is per unit, multiply by what? Multiply by what? Multiply by 70,000. Why 70,000? Let's have a look. Check again. It says now read again. Variable cost is 1.5 per unit sold. All right, per unit sold. And how many we sell? 60,000. Because this is selling and distribution cost. Selling and distribution cost is not depends upon how many unit we produced. Selling means selling cost is related to your selling unit. Distribution cost related to your selling units. Because if you sell more units, you want to sell more units, your selling and distribution cost will be increased. All right. So that's why this is 1.50 per unit sold. So we multiply by 60, not by 17. All right. So make sure, be careful about it. So now, how much is, variable is 1.5 multiplied by 60,000, which is your sales unit. So how much is variable? How much is this? 60,000 multiplied by 1.5? 90,000, yes. 90,000 right? And fixed cost. How much is your fixed cost? Fixed non-manufacturing cost. How much is this? $60,000. Is it 60 or 80? Let's check again. Your cost is 80. Fixed cost is 80. Why you said 60 multiplied by 1/4? Not 60, 80. So how much is fixed cost for first quarter? So let me explain you if you're quite confused. I guess what are you doing here? I think some of you write like this, 80,000 divided by 12, right? Multiply by 6. If you multiply by 6, you got for 6 months. We need for 3 months and 3 months here. So means divided by 2 as well. Then you get 3 months. All right. So 80,000 for 12 months, right? 80,000 for 12 months is per year. We need just for 3 months. We just need for 3 months because first quarter, January, February, March. So 1 quarter, 3 months, right? So that's why 80,000, 3 months, right? So it will be 20,000, right? 40, 20, 20,000. So that's your fixed cost. Is that okay? Is that okay? Yes or no? Say something. Fixed cost. Any question regarding fixed cost, fixed manufacturing cost, fixed non-manufacturing cost? Any question for fixed cost? Please say something, then we move on. So no question, all right. Okay, so fixed cost is now 20,000. 20,000 means 80,000 for 3 months, which is 20,000. So total non-manufacturing cost is 110,000. So how much is your net profit? Now tell me. How much net profit? Net profit is 1,525,000. All right. So that's your profit for first quarter. So let's move on to the second quarter. For second quarter, let's start with the sales. So how much is the sales for second quarter? How much is the sales? Second quarter? 4 million and 4,050,000. Right. So that's your sales for second quarter. Right. So let's calculate quarter two cost of goods sold. Right. So we calculate cost of goods sold for second quarter. Manufacturing cost per unit, which will be the same, 17.75 pounds per unit, right? Multiply by how much is opening for second quarter? 10,000. And how many we produced? 100,000. And how much we sold? How much is closing? Closing 20,000. Right. So 110 minus 20 is 90. 90 multiplied by 17.75. So how much is cost of goods sold? $1,597,500. So 1,597,500. So how much is gross profit? $2,452,500. 2,452,500 minus total non-manufacturing cost. How much is total non-manufacturing? So now give me total non-manufacturing. So you calculate variable, then fixed, and then you add variable and fixed for second quarter and give me the answer. $155,000, right? 155,000. In this 155,000, the fixed is same, which is 20,000, right? And variable is 135,000, right? So variable cost per unit is 1.5 multiplied by sales unit for second quarter. All right, so that's your non-manufacturing cost for second quarter. So how much is profit for second quarter? $2,297,500. All right, 2,297,500. All right, so this is your profit for using profit for 2 different quarters using absorption costing. All right. So question 3 is finished. Do you have any question regarding question 3? Or we move on to marginal costing? Anybody has any question? No question. So let's move on to marginal costing. So I will explain you marginal costing first, and then later on we will do calculation for all these 3 questions. Calculate net profit using marginal costing. All right. So let's start with marginal costing. Marginal costing. So another name of marginal costing is a variable costing. Like absorption costing has another name, which is full costing, right? Full costing. Why we call it full costing? Because both fixed and variable part of production, part of manufacturing. That's why absorption costing also known as full costing method. Marginal costing method is called variable costing method. Why we call it variable costing method? Because under marginal costing, when we calculate manufacturing cost, we only use variable manufacturing. So we do not use fixed manufacturing with variable manufacturing. So we separate variable manufacturing from fixed manufacturing cost when we calculate our profit. All right. So I hope you remember the structure or the formats of marginal costing. If you do not remember, I give you a quick view over the marginal costing format. So under marginal costing, so you know that total cost divided into 2 parts, variable and fixed, right? In this variable, we have manufacturing cost, and we have non-manufacturing cost. All right. And fixed also have manufacturing cost and non-manufacturing cost. All right. So you can see that fixed manufacturing and variable manufacturing, we keep them separate. So keep them separate means when we are estimating our manufacturing cost, we do not involve fixed cost here. All right. Why? Because there is an argument that fixed cost do not contribute to increase either production, all right, or fixed cost do not increase the selling units. It does not contribute anything. That's why we keep variable manufacturing separate from fixed manufacturing and variable non-manufacturing from fixed non-manufacturing. We keep them separate because, as I said, fixed costs do not contribute. Fixed costs do not contribute means doesn't matter. You increase production, decrease production. Doesn't matter. You sell more units or less units. Your fixed cost is unchanged, remains same. So that's why they are not contributing anything. Variable cost, variable manufacturing cost contribute. And what inside variable manufacturing cost? Direct material, direct labor, maybe direct expense or variable overhead, right? Only variable manufacturing. And same thing, variable non-manufacturing. What could be variable non-manufacturing? Variable non-manufacturing involve marketing, advertising, maybe transportations, packaging, distribution, labeling. All these kinds of costs are variable non-manufacturing cost. All right. Fixed manufacturing, you know, fixed manufacturing, especially fixed overhead, could be depreciation, could be rent or supervisors, right? Non-manufacturing cost, which is fixed, is a administration cost. The cost which belongs to the office could be administration, people, whoever is working in an office, the salary of those people more likely to paid in a form of like fixed, right? We pay them fixed salaries, so it's a fixed cost, right? Another example is our office. We have any equipments in office, could be air conditions, could be computers, any other electronics equipments or any other kinds of equipments we are using in an office, and that equipment has a depreciation. So depreciation for office equipments, right? Office machines or office equipment. Another example for fixed non-manufacturing is rent, office insurance. All right, so these are the example of fixed non-manufacturing cost. All right, so that's why variable cost also, variable costing is the another name of marginal costing. All right, so now let's have a look at the structure of marginal costing, and then we will see how can we calculate profit under marginal costing, right? Marginal costing format. So we have sales, obviously, minus variable manufacturing cost, all right, minus variable non-manufacturing cost. So sales minus total variable cost, variable manufacturing and variable non-manufacturing. So this is called a contribution margin. Contribution margin. Now, what does it mean, contribution margin? Contribution margin means we consider only those type of cost which focus or which contribute to increase the company margin, right? Like as a variable non-manufacturing cost is contribute to increase the sales, and variable manufacturing is contribute to increase production, all right? So this variable cost is contribute to increase or maximize the contribution. So only variable cost is contribute to maximize the production or revenue, sales unit, right? So that's why this is called a contribution margin. So sales minus total variable cost is a contribution margin, right? Minus fixed manufacturing cost. Fixed manufacturing cost. Minus fixed non-manufacturing cost. Right. So contribution margin minus fixed cost is called net profit. It's called net profit. Net profit. Right? So this is the way to estimate profit under marginal costing. All right. Now, have a look that how can we estimate all these four types of cost, which is variable manufacturing, variable non-manufacturing, fixed manufacturing, and fixed non-manufacturing. How can we estimate these four kinds of cost? Let's have a look one by one. The first is a variable manufacturing cost. How can we calculate variable manufacturing cost? The formula for variable manufacturing cost is a variable manufacturing cost per unit, variable manufacturing cost per unit multiplied by cost of goods sold units, which is same. Opening inventory plus production minus closing inventory. That will be same like as absorption costing, but here variable manufacturing cost is different because here we are only using variable manufacturing cost. So variable manufacturing cost formula is, how can we estimate it? Again, it's only variable manufacturing. So that's why direct material cost per unit, right? Direct labor cost per unit, right? And variable overhead cost per unit. That's it. This is your variable manufacturing cost. All right. So this number, variable manufacturing cost per unit, multiplied by this opening plus production closing. That will be same. Now, next is what is a variable non-manufacturing? Variable non-manufacturing gonna be same like as we normally do that. It's a variable non-manufacturing, let's say selling and distribution. So cost per unit, variable cost per unit multiplied by sales unit, right? So variable cost means variable cost related to non-manufacturing, not variable cost related to production, all right? Variable cost per unit multiplied by sales unit, right? Fixed manufacturing, you know that, right? Fixed manufacturing You know that, which is fixed overhead. Same as we had before, which is fixed overhead. Fixed overhead. All right. And fixed non-manufacturing. That's also given in your question. That number also given. That number is given in your question, right? So we got all kinds of cost. Let's go to the question. So I mean, you will go to the question and you calculate net profit for question 1, 2, and question 3. All right. So do it now. So we do it question 1 first for marginal costing, and then 2 and 3. I hope all of you already finished question 1. So quickly have a look what inside information. Question 1. So you already done absorption costing, so you know all the information regarding this question 1. So we have selling units, we have £5 is our total variable cost. Fixed cost per unit is £3, and we have unit produced and unit sold for 3 months. So we are calculating net profit by month in your question 1. Right? Okay, so this is January, February, and March. All right. So let's start with the sales. How much is, so this is your question 1, marginal. Marginal, right? Marginal costing. So how much is sales for January? January sales, 16,500, right? Now we have to minus variable manufacturing cost. So we can calculate variable manufacturing cost. In this variable manufacturing cost, we have a variable manufacturing cost per unit, right? Multiply by opening plus production less closing. All right. So how much is a variable? So start for January, February, and March. Right. So how much is a variable manufacturing cost? Total variable manufacturing cost per unit. Variable manufacturing cost per unit. Here, variable manufacturing cost per unit, this number. 5. £5 per unit. Multiply by how much is opening? 0 plus production 3,000 less closing, which is 1,500. So we got it 1,500. So 1,500 multiplied by 5 is a 7,500, right? So that's your variable manufacturing cost, 7,500. Now minus variable non-manufacturing cost. How much is variable non-manufacturing cost? 0. Yes, we don't have any information regarding this. So how much is contribution margin? Contribution margin. How much is contribution margin? 9,000. Right. Minus fixed manufacturing cost. Minus fixed non-manufacturing cost. How much is a fixed manufacturing cost for the month of January? $4,500. 4,500. And how much is a fixed non-manufacturing? 0. Yes, it's 0. So the profit for the month of January is a 4,500. All right. So this is January profit. Now let's move on to the February. How much is the sales for February? 22,000. Minus variable manufacturing cost for February. Variable manufacturing cost per unit is a 5. Multiply by, for February, how much is opening? Opening for February. $1,500. Plus production. How many we produced? 500. And how much is closing? Zero. Yes, closing is 0. So 1,500 plus 500 is 2,000. 2,000 multiplied by 5 is 10,000. So variable manufacturing cost is 10,000. And variable non-manufacturing is 0, right? So contribution margin is a 12,000. Minus fixed manufacturing. How much is fixed manufacturing? 6,000. It must be same. Okay, anyway, you calculate by per units, it's okay, but you're supposed to calculate by using a total. So let me show you. So your fixed manufacturing cost is 108,000. All right. So we are calculating for month. So which means 9,000. This is the right way to calculate. But what you did, you 3 multiply by production. All right. So you 3 multiply by production, which is 2,000 for the month of February. So that's why you got it 6,000. But actually, it should be 9,000 instead of 6,000. Anyway, it's okay. So if you use it 6,000, that's fine. And fixed non-manufacturing is 0. So profit for the month of February is 6,000. All right. Now, let's move on to the March. How much is the sales for March? Okay, so sales for the month of March is 22,000, and variable manufacturing cost. So it's a £5 multiplied by opening is 0 plus how much is production for the month of March? Production is 4,000 less closing. How much is closing? 2,000. Closing is 2,000. So which is 2,000. 2 multiplied by 5 is 10. Non-manufacturing cost, variable non-manufacturing cost is 0. So it's 12,000. Minus fixed manufacturing cost. How much is fixed manufacturing cost? Fixed manufacturing cost, how much? 6,000. And fixed non-manufacturing is 0. Which is here? This is 6,000. So this is your 6,000 profit for the month of March. So that's your January, February, and March profit for your marginal costing. All right. So any question? Question 1? Any question for question 1? No question. If no questions, then we can have a break now. And then after 15 or 20 minutes, we will continue to question 2, and then we finish question 3. Right? So in today's video, we will not cover next, which is cost, volume, profit. We only cover the marginal costing. All right. So next topic we'll cover next week. All right. So we can have a break. So I'll see you after the break. Okay, so let's move on to the question 2. So quickly have a look at the question 2. Question 2, we have selling price, which is £30 per unit. And we have this one. It's your material, all right? It's your raw material. So we have raw material 1, raw material 2, right? We have labor, we have variable cost, we have a fixed cost, 15,120 per year, right? Some other information, and then finally, January, February, and March, production unit and sales units. So now we need to calculate net profit using marginal costing, right? So we have January, February, and March, right? So let's start with the sales. How much is sales for January? Total sales? $5,700, right? Minus variable manufacturing cost. So variable manufacturing cost. For variable manufacturing cost, we need variable manufacturing cost per unit multiplied by opening plus production minus closing. Right. So in variable manufacturing cost, we have direct material. How much is direct material? Or if you want, you can tell me the total variable manufacturing cost. How much is total variable manufacturing cost per unit? $11, right? 11 multiplied by 11 pounds. Right. Multiply by how much is opening? 0 plus how much is production? 220 is production, and how much is closing? 30 is closing. So 90 multiplied by 11, 990, right? 990, right? This is variable manufacturing cost. Minus variable non-manufacturing cost. How much is variable non-manufacturing cost? Variable non-manufacturing cost, 0. So how much is contribution margin? Contribution margin. How much is contribution margin? Variable manufacturing cost is 200. Oh, sorry. 990, it should be 200. 2090, okay, all right. It must be 2090. Okay, so how much is contribution margin? $3,610 is a contribution margin, right? Minus fixed manufacturing cost. How much is fixed manufacturing cost? $1140, right? So make sure you simply divide it by 12. Right, so let me check again one more time. So it's 15,120 divided by 12, right? So 15,120 divided by 12. Oh, we calculate by month. So I don't know, why did you get 1140? I think we have to simply divide it by 12, because why? We are calculating January, February, and March. So for 1 month, right? So 15,120, 15,120. Right, so 15,120 divided by 12. This is 1260 for January. So now remember one thing, I think what you're doing here, every time what you do, I think you convert this fixed cost into per unit, and then you per unit you multiply by production unit, right? So you convert this one into fixed cost per unit, and then you multiply by production cost, you multiply by production units, right? Production units. Normally you do that. You don't need to do that, all right? Why you have to, is total is given. You simply multiply by, 1 year is given. You just simply need to divide it or convert into 1 month. Make it simple. Under marginal costing, but under absorption costing, you need a fixed cost per unit because you are calculating total manufacturing cost per unit. So here, you have a total, you convert into per units, and then you convert into total again. You don't have to do this, all right? Because fixed cost is not part of production. Fixed cost not part of production means under marginal costing, fixed cost do not contribute to produce product. If fixed cost is not contributing to produce product, why are you convert a fixed cost using production unit? Right? That's the whole idea for the marginal costing. So I repeat, under marginal costing, only variable cost contribute in manufacturing. Fixed cost do not contribute. So that's why you keep fixed cost separate from variable, right? So if fixed cost do not contribute in production, then why you need to calculate fixed cost using production unit? All right, so that's why do not calculate fixed cost using production unit. Calculate fixed cost as a total, which is 15,120 divided by 12, which is 1260. Everybody understand this point? Understand? Okay, so 1260. So this one is 1260, which is 15,000. How much was the number? 15,120 15,120 divided by 12. Simply, you are calculating for 1 month, which is 1260. So, how much is your net profit for the month of January? $2,350, right? Okay, let's move on to the February. How much is sales for the month of February? $3,600 minus variable manufacturing cost. So that was January. Now February. Same, that will be 11 pounds per unit multiplied by how much is opening? Opening is, for the month of February, how much is opening? $30, yes, 30 is opening, plus how many production? 180 is production. And how much is closing? How much did you calculate closing? 10. So 80 plus 30, 210, right? 210 minus 10 is 200. 200 multiplied by sales is February is 6,000. Okay. So make sure you check again. Someone said 6,000 is a sales for the month of February. All right, so check again. Yes, it should be 6,000. So make sure you check again. All right, so how much is a variable manufacturing cost for the month of February? Variable manufacturing cost here, how much? 2,200. Variable non-manufacturing cost is 0. And how much is contribution margin? Contribution margin is 3,800. All right. And fixed manufacturing cost? Fixed manufacturing cost will be same. Yes, 1,260. So how much is a profit for the month of February? $2,540, right? That is the profit for the month of February. Now let's move on to the March, right? So how much is the sales for March? Sales for March, 6,300. And how much is a variable manufacturing cost? So let's have a look here. Variable manufacturing cost for the month of March, we have 11 pounds. Right? Multiply by pounds, multiply by how much is the opening for March? 10, yes, it's 10 plus how many we produced? 230 we produced, minus closing 30, yes. So 210 multiplied by 11 is how much for March? 2310. Variable non-manufacturing cost is 0. So how much is a contribution margin for the month of March? $3,990. That's right, 3,990. And fixed manufacturing cost will be same, which is 1,260. So how much is a profit for the month of March? 2,730. 2,730. Right? So this is your profit for 3 different months: January, February, and March. All right. So this is your question 2 finish, which is for marginal costing. That's for marginal costing. So let's move on to the question 3, the last question for marginal costing. Question 3, marginal costing. All right. So question 3 is the same scenario that we have. We have 2 different quarters information: quarter 1, January, February, and March, and quarter 2, April, May, and June. Right. So the question that we did in the beginning of this lecture for absorption costing, same question now we are doing for marginal costing. Right. for January to March and April to June, right? So we start with the sales. How much is the sales for the month, the first quarter, January to March? It will be same like as absorption costing. So how much is the sales? 2,700,000. Right. Now minus variable manufacturing cost. Right. So we will calculate variable manufacturing cost. So we need variable cost, variable manufacturing cost. Variable manufacturing cost per unit multiplied by cost of goods sold in units, which is opening plus produced less closing, right? So for quarter one, which is January, February, and March. So how much is total variable manufacturing cost per unit? Total variable manufacturing cost per unit. Have you finished this question, question 3? 16.5. 16.5, all right? So remember, in this 16.5, you have to exclude fixed cost. So do not plus fixed cost because it's a variable manufacturing cost. Now multiply by how much is opening? Opening inventory is 0 plus how much is production? 70,000 minus closing. How much is closing? 10,000, right? Yes, it will be same like as absorption costing. So 670 minus 10 is 60. 60 multiplied by 16.5. So how much is variable manufacturing cost? 990,000, right? Minus variable non-manufacturing cost. So how much is variable non-manufacturing cost? 110, I guess. I don't know, maybe 100. Yes. How much is variable non-manufacturing? 90, yes. 90,000. So how much is your contribution margin? First quarter contribution margin is 1,620,000. All right. So minus fixed manufacturing cost. How much is fixed manufacturing cost? So make sure, yes, tell me how much fixed manufacturing cost? Fixed manufacturing cost. Fixed manufacturing. Tell me how much. No, not 75. Yes, 100,000. Why 100,000? Again, that I explained you before, under marginal costing. So I think I have to write down, so you will be sure about it. So let me write down for marginal costing here. So remember, so I'm writing here. So all right, under marginal cost, fixed overhead do not contribute in manufacturing. That is why we exclude it. Excluded means we keep it separate. All right, we keep it separate, our fixed cost. So what does it mean? It means when we are calculating fixed cost, fixed overhead, we will not use production unit. That's the meaning of this, right? So it means we estimate fixed overhead, which is fixed manufacturing cost. We will not right? We will not use when we estimate fixed overhead, we will not use production unit, right? So we use the total fixed cost and we divide it into, depends, we are calculating 1 month or 1 quarter or 6 months or 1 year, all right? So that's the whole idea here, all right? If in your question 1, same thing. If in your question 1, I don't remember actually. So let's have a look again. If in your question 1, I think you calculate by production unit, right? So make sure you fix it. Fix it. All right. In your question 1, it should be same, right? So make sure you fix it. And so you, whatever number you have, I think 108. So I think it will be 9,000, I guess. So you have 108,000 divided by 12. So which is 9,000. So 9,000 each here, right? 9,000, 9,000, 9,000, right? So first year, you don't have any profit. So first year will be break even, all right? First year will be break even, all right? For second year, we still have a profit, right? Which is 3,000. So make sure you also fix it here and fix it here, right? So keep in your mind this thing. And I think we did exactly the same thing in our question 2, which is correct. Yes, it's okay. We calculate using the total, right? Same thing for question 3. For question 3, your fixed manufacturing cost is 100,000. Right? Minus fixed non-manufacturing cost. How much is fixed non-manufacturing cost? 20,000. So how much is a profit for first quarter? Net profit? 1.5 million, right? This is your net profit. Net profit, right? So let's move on to the second quarter. How much is the sales for second quarter? Sales for second quarter? $4,050,000. Minus variable manufacturing cost. How much is variable manufacturing cost for quarter 2, which is 16.5 is the same. Multiply by opening. How much is opening for quarter 2? 10,000, yes. Plus production, how many we produced? Production is 100,000. Right? Less closing, how much is closing? 20. So which is your 90. 90 multiplied by 16.5 is how much? Variable manufacturing cost? 148,530. Right? Now variable non-manufacturing cost. How much is variable non-manufacturing for April to June? 135,000. All right. So how much is the contribution margin for second quarter? $2,430,000. And how much is your fixed manufacturing cost? Yes, it will be same, 100, right? And for fixed non-manufacturing cost, that will be also same, 20,000. So how much is a net profit for second quarter? 2,310,000. All right. So that's the whole idea, right? Now, remember, under marginal costing and absorption costing, your profit may not be the same, right? Look at your first quarter. Under marginal costing, your profit is 1.5 million. If you go to absorption costing, so your profit is 1,525,000, so 25,000 extra here, right? The reason is that obviously under absorption costing, manufacturing cost per unit involve fixed cost, but under marginal costing, variable manufacturing cost per unit is different because variable manufacturing cost here is 16.5. Manufacturing cost 16.5 under marginal costing. Manufacturing cost per unit is 16.5 and under absorption costing 17.5. 17.75, right? So yes, so obviously if your manufacturing cost per unit is different, your production cost will be different. As a result, your contribution margin or gross profit will be different, net profit will be different, Same thing happened with your Q2 for marginal and absorption costing. So that's why profit for the marginal and absorption costing is not same, right? So that's all for marginal and absorption costing. So marginal and absorption costing part is finished for your topic 5. All right. So now next lecture, next class, which is next week, Wednesday, right? So next week, Wednesday, I'll see you in university. And then we will move on to the cost volume profit analysis. We also call it break-even analysis. So next week, we will finish a break-even analysis, all right? So anybody has any question regarding question 1, 2, and 3, or absorption costing in the beginning, or marginal costing? Any question? Any questions? Anybody, please say something. In question 1, the answer for fixed manufacturing cost is 4,500. Is right or wrong? Okay, let me check. For question 1, okay. So fixed manufacturing cost. Question. Fixed manufacturing cost. Fixed manufacturing cost is wrong. This number is wrong. All right, it's wrong. It's wrong. It's wrong. Right number is 9,000, 9,000, and 9,000. So how we get 9,000? We got 9,000 like this. All right. So that's why first year here your contribution margin is 9,000. All right. Your fixed manufacturing cost is 9,000. Fixed non-manufacturing cost 0. So the first year 9,000 minus 9,000 is 0. So you don't have any profit. That's why I said first this is wrong. So first year you have break even, right? Second year, 12,000 minus 9 is 3,000. So 6,000 wrong, 3,000 for second year, second month, right? For third, 12 minus 6, which is wrong. So 6,000 is wrong. So 3,000. So your net profit is 0 for January, February 3,000, March is 3,000. Right? So fixed manufacturing cost is 9,000, 9,000, and 9,000 for 3 different months. When we calculate 2 methods, the net profit of them not equal. Yes, that's right. Profit of marginal costing and profit of absorption costing will not be the same. It will be different. If it's same, I don't know, maybe it's a coincidence if it's same, all right? Or your question is wrong, all right? But generally, you can see that you can compare your all profit for 3 different questions with marginal costing profit with the absorption costing, and you can see that it's not same, right? If it's same, that's why I said most probably it's wrong or it's a coincidence if it's matched, but normally not same, all right? So, any question? Okay, no question. If no questions, then we stop here. So I'll see you next week in university. All right? Thank you. Bye-bye.